Hey everybody, and welcome to this earnings beats Q&A session for Thursday, January 23rd, 2025. Matt Townsend is joining me today. Matt is, well, many of you know Matt through customer service, but he is a longtime research and sales associate for Earnings Beats. He's been with us several years now. And of course, our producer of the video, Tyler Bowley, he's my son and does a lot of our video work on YouTube, and also helps in the research area as well as a research associate. So anyhow, that's the three of us that you've got today. We got a lot of questions, Matt. I looked at them, tried to get some of the stuff done here ahead of time so we don't spend too much time, but you know me, I'm probably going to talk a little bit too much. But anyway, what questions we have this week?
All right, cool. Well, we'll start out with Sergio, and sorry we missed you last week, Sergio. He was wondering about the numbers that you pull up with the S&P 500, basically by day. So the January 13th, you have a minus 21.57%. The next day would be January 14th, the 60% gain. He was basically wondering what those numbers represent.
They're just fictitious. Now I'm going
Fictitious.
to show you. I'm going to show you what they are. So I've got an Excel spreadsheet on the S&P 500 goes back to 1950. So you got that on your screen here. And so one of the numbers that Matt just talked about was January 13th. That's an annual performance number that I have just for that day. So essentially what I do on this spreadsheet, I mean, you can see this is a serious spreadsheet with a lot of data going back all the way to 1950. And so what we do and how I come up with that percentage on your, or how I come up with the percentage on each day is, let me get back over here to the totals. So on January 13th, I'll highlight it coming across here. So if you go back to 1950, January 13th has been higher on 24 different days. So, in various years. And January 13th has been down 29 times. So it's been down a little bit more than it's been up. The cumulative percentage. So if January 13th, 1950, it was up 0.2%. And the next day or next year, January 13th, 1951, it was up 0.3%. All I'm doing is I'm adding those going across or subtracting them when that percentage is down. And I come up with a cumulative percentage on January 13th of minus 4.52%. So that's just taking each of those daily percentages on the 13th throughout history and just adding them together. And then we come over to the number of days where we've actually had action on the 13th, because sometimes 13th is going to fall on a Saturday or Sunday. So these are the actual number of times that that we've seen the 13th trade, 53 different days since 1950. And then I take the number of trading days in a year, which is estimated to be 253, unless it's a leap year, but roughly 253 trading days. And then all I'm doing is I'm taking this minus 4.52% and multiplying it essentially by 5, which is 250 days versus 50 days, roughly. So you're just, interpolating, making it, on an annualized basis. So that's why I say this is annualized performance. And I just do that every day. So that's where you're getting the minus 2157 on the 13th, plus 60.98 on the 14th, plus 25.13% on the 15th, and so forth. So all I'm doing is just simply taking the numbers from this spreadsheet and keeping this spreadsheet up to date. Again, dating back all the way to 1950 on the S&P 500, back to 1971 on the NASDAQ, and back to 1987, 88 on the Russell 2000. So hopefully that will explain how I come up with those numbers.
And as you said, history is your friend
Yes.
many times. So I think that answers Sergio's question. We'll go ahead and move on if you're cool with that.
All right.
So we have a question from Steve. He basically was wondering if you could look up under the hood of semis. He said the Dow Jones semi index looks quite different than the main ETF, the SOXX and the SMH. Maybe you could check under the hood.
All right. Hold on one second. Going back um, to my stock charts. All right, should have this up now. So here's the, well, first of all, let's just take a look at the various um, ETFs or indexes that was referred to here. So this Dow Jones US Semiconductor Index, you can see recently, early January, went up and we put in a high over the double top from back in June, July. And now recently we're coming back up trying to threaten to break through that level again. So from highs, there's a slight upslope. If we look at the SMH, you can see that the double top back in June and July was the high. We haven't gotten back up there yet, but we did just break through the early January high, which we hadn't done yet on the index. And then if we bring up the third one, the SOXX, the SOXX, you can see we haven't broken back out to this high, but we're still way below the highs from June and July. Now, first thing I'll show you is just a chart of NVIDIA, because if you look at NVIDIA, it looks a lot more like the Dow Jones US Semiconductor Index. NVIDIA broke out. You can see again the slight top moving higher, or this double top from back in June, July, moving higher recently, trying to make that breakout. So NVIDIA looks a lot more like the Dow Jones US Semiconductor Index, which tells me that there's probably a lot of influence from NVIDIA on the index itself. I don't know what the breakdown is of the Dow Jones US Semiconductor Index, but what I do have is the breakdown of both the SMH and the SOXX. So on the SMH, first of all, there are the top 10 holdings represent 73% of the SMH. And those holdings are number one, NVIDIA, which is almost 20%, Taiwan Semiconductor, which is 12.5%. Then we've got Broadcom, which is 10%. So those three would be roughly about 42%. And then below that, we have ASML, AMD, Advanced Micro, Texas Instruments, Qualcomm, Applied Materials, many of those other names. And I don't know how heavily those names are weighted in terms of the Dow Jones US Semiconductor Index. But those four names just by themselves, along with analog devices, comes in somewhere around 20 to 22%, which is pretty significant. If you've looked at their charts, those companies I just talked about have gone down quite a bit. So I think that's probably what leads to the SMH being close to the Dow Jones US Semiconductor Index. You can see that this number is much closer to being at the high than, say, the SOXX, the SOXX, which you can see is down quite a bit from the high. And then, of course, the semiconductor index, as I showed, had already gone up to a new high. Well, if we look at the SOXX, the reason why the SOXX is underperforming by so much since June, July is, once again, we take a look at the leadership. Leadership, number one is AVGO, Broadcom, which isn't bad. Broadcom's been pretty good lately. That's 11.5%. NVIDIA is only 7.8%. So there's a lot less emphasis in the SOXX on NVIDIA. And then if we get below NVIDIA, AMD, which is little over 7%, Qualcomm 6%, Texas Instruments 5.9%, and then you get some of the semiconductor equipment companies like Lam Research and KLA, which both are close to 4%. Anyway, there's a lot more weighting towards stocks that have not done as well. So for instance, let's go back. There was NVIDIA, which has done well, but look at, here's Broadcom. So Broadcom's done pretty well. So the top two components of the stocks, AVGO and NVIDIA, which are about 19%, have done well. But when we get down below that and look at the next four, we've got AMD. Look at AMD's chart down near 52-week low. That's 7% of the SOXX. Qualcomm. See, I think I got Qualcomm. Yep. Qualcomm is rebounding a little bit now, but you can see from June to where we are now, you see how far we are off that high. Next up, Texas Instruments. Texas Instruments was at a high in November, but it's come back down. So it's down from where we were in June, July. And I don't know, I think that was it, but I could probably pull up a couple of others. Marvell, that one actually has done pretty well. That's about 4.75%. But Lam Research has been down quite a bit. KLAC, which is KLA Corp, that's come back recently, but still down quite a bit from the summer. ADI down from the summer. So I think there's just more stocks that are weighted heavier in the SOXX that simply are just underperforming and have been underperforming since June, July, especially one like AMD, which is at that 52-week low. So it's just the makeup. And when we talk about these ETFs, and anytime I do the model ETF portfolio, I bring this up, is when you buy into an ETF, you got to know what you own. And this is a really good example. It's a great question because you look at the index doing one thing, and then you look at these two ETFs, which are doing different. It's like not all semiconductor ETFs or indexes are created equal. They've got a different basket of stocks within them, and you have to know what they own in order to determine which one you want to own. So anyway, I thought that was a really good question.
So I thought that was a great answer too. So moving on, we got a long-term question from Doug. So he wants you to bring up your long-term S&P chart, the one that shows all the secular bears and secular bulls. He states the only real difference from a secular bull from 1980 to 2000 was twice the length from the 1968 to 1980 bear. The other two cycles were similar in length. My question could be uh, the 1980 to 2000 bull could have extended due to a secular decline in U.S. bonds. If we look at the bond yield, uh, then we could easily say that the 42-year decline in interest rates is over. This is a long one, sorry. Uh, and if this is the case, couldn't we be in for another secular bear market in the beginning of 2026?
Okay, yeah, that's a lot there.
Sorry.
It's all right. Yeah, I remember going through and reading the question, and I know, there was discussion also about this secular bear back, from 30 to 50 being 20 years long. Couple of things, first of all. Number one, this isn't a perfect science. So everybody's free to interpret whatever they want to interpret from the chart. What I would say is that going back into the 1920s and trying to compare anything back then, at least prior to 1934, because that's when we had the Securities Act of 34, and that kind of eliminated a lot of the fraud and so forth, things that took place in the 1920s and into the 30s. Of course, that big, huge crash where we saw the major indices lose more than 90% was the biggest drop in our history. But it also came on the heels of one of the biggest gains in our history. So you got to keep things in perspective. But I think it emphasized a lot of things that was unfair for investors. And so that's why the SEC was created as part of that 1934 Securities Act. And so at that point, we actually had a regulating body which created laws about insider trading, required companies to start reporting to the SEC. And so I just think made for a better investment environment. So I would pay more attention to what happened after about 1934, which is why a lot of times when I say that we break out to a secular bull market in 1950, I'm comparing only the tops from 1937 and 1946. And I don't go back to this top that we had in 29 because it was unregulated. I don't know exactly what was going on back there, but and generally speaking, 90 years ago, we got a totally different market than we had back then. But for me, it's all about just the cycles. Cycles make sense to me that we're going to go through periods when stocks are going to be in favor. We'll go through longer term periods when stocks are not in favor. And I think that's what this chart kind of demonstrates. We had a nice little channel on this push to the upside, then we went sideways. But that sideways action, it looks like it was really nothing. But in 1974, 73 to 75, that 2-year period, we had to withstand about a 60% drop, or certainly more than 50%, somewhere in the 50 to 60% range over 2 years. And so this was no little thing. It's just kind of made a little small when you look at it over a 100-year period. Same thing with the 2000 dot-com bubble and the financial crisis that we had in 2007 to 2009. These were not little small pullbacks. These were massive 50 to 60% declines. Now, when we start trying to call a bear market, a secular bear market, a long term, which in my opinion, last roughly a dozen years based on history, you got to be careful doing that because in my lifetime, there's only been two. I mean, we've only started two secular bear markets in my lifetime. First one, call it 68 if you want. You could argue that it really wasn't until 73 when we topped because that was a higher high. But it just had that feel that we were kind of topping and, kind of rolling over. So I selected 68, but again, you could choose 73, and then this bearish period would be much shorter. You can see in 2000, we connected from the all-time high. We started at 68, actually wasn't even the all-time high. So there's a lot of different things you could do. And stories that I guess you could tell in your own mind based on what you see on this chart. But for me, it just makes sense that money will rotate over long periods of time. Stocks will be in favor, stocks won't be in favor. And that doesn't apply to these cyclical bear markets like the one we had in 2022, where we go down for 9 months, or the pandemic in 2020, where we went down for 4 weeks, or 2018, where it was the fourth quarter trade war, where we went down 20% on the S&P 500. So those are just normal parts of a longer term secular bull market. So I guess, the question is, when I look at these and I look to see when a secular bear market is starting, you go through a period where, the long-term PPO, this is a monthly PPO, and the bear market really didn't start to kick in until this monthly PPO went negative. Same with 1970. This is when we had our first big drop through the PPO center line. And what the PPO is telling us, if you're looking at the PPO, this is a 12 and 26 period exponential moving average, a comparison of those two. 12 months is a year, 26 months is 2 years and 2 months. And so for this PPO to turn negative, you've got to see weakness for an extended period of time, or at least a slowing of the momentum to the upside. Look at where we are right now. I mean, I look at just this one signal and I'm seeing the bullish momentum on a long term accelerating to the upside. That has not been the case during the start of any bear market. So I think we get in this process of every time we hear bad news or we don't believe something that's going on in the market, we want to call it a secular bear market. Just remember, over the last 100 years, we've had three of them. So, since I came back to earnings beats and started this business again full time back in 2019, we've gone through two bear markets, and I've gone through many times getting questions from members saying, "Is this the start of a secular bear market?" I mean, I wish I had like $5 every time I got a question on that, because there have been a lot of those. I understand the questioning of short-term cyclical bear markets because they will happen from time to time. But again, just remember, secular bear markets don't happen very often. So you've got to be beaten over the head with evidence, and I'm just not seeing it. So I'm just going to leave it at that, because I could go on and talk about this for 4 hours. But everybody can interpret this chart however they want to interpret it. But for me, based on history, I think we've got years to go in this secular bull market before we have to worry about the bear.
Moving on, we got Shrikant. He said, "I know Tom discussed how to calculate the 5-day put call ratio from the past."
Okay, I'm not sure what the question is there, but essentially what
Yep.
I do is I look at the equity only put call ratio, which it goes up and down, it fluctuates. Day to day probably doesn't really matter too much. But what I did is I just started doing some research, and over the years, I just noted that when you get a 5-day moving average of the put call ratio that goes way low to the downside, what that represents is that it's an extended period of low put call ratios, meaning that the number of puts, think about it as a fraction, if you can go back to the math, old math and algebra and all that. But if you take the numerator of a fraction being puts, which is where if you're buying a put, you generally want whatever you're buying that put on, whatever security, you're expecting it to go down. If you buy a call, you're expecting it to go up. Now, one thing that the equity only put call ratio doesn't tell us, what I can't find out for sure, is when someone opens a contract, when they open, a put contract or a call, are they buying it or selling it? Because you can sell to open. It's like shorting a stock. So you can sell a call to open, and then at some point you have to buy it. You got to cover that sale with a buy. I don't know exactly how many puts and calls are being bought versus sold. I don't know how you can come up with that information. If anybody knows, I'd love to hear it. But I have talked to market makers, actual market makers, and what they've told me is that the overwhelming majority of equity calls and puts, equity, not index or institutions a lot of times, but individuals buying or trading equity calls and puts, most of the time they're opening with a buy. And so that's what I rely on. I've done no studies. I'm not a market maker, never worked for one. So again, there are limitations to everything we do, all the research we come up with. That's a limitation that I don't know how to really do anything about. But based on my understanding and based on what I see on the charts, anytime you get these readings that are really low, it's telling us that there are a lot more calls being traded than puts, which generally means that retail traders are much more bullish than they are bearish. And when that sentiment reading gets too bullish, when you start getting these lows down here, that's when the market has had a historical tendency to reach a top. Not every time. Look at this one back in February 2024. We got down low, a lot of calls were being bought, and you might say, well, we did pull back a little bit. That's probably 1% or less. And then we kept going higher. So it's not a guarantee, it's a warning sign. If you're getting ready to go outside and play golf and you see these, massive dark clouds in the distance and lightning bolts coming out of it, then you probably think, you know what? I might want to take an umbrella or I might not even want to play golf because I can see warning signs. Um, as opposed to going outside and it's beautiful sunny skies. Then you don't have to worry about anything. Doesn't look like there's much risk at all. That's all this does. It just provides us a little red flag from time to time where we can experience pullbacks. And look at what we've done since December with all of this complacency in the fourth quarter of 2024. We finally reached a point that's been difficult for the S&P 500 to get back up to the high. Now, recently, last couple of days, we have gotten back up to 6,100. But again, this is telling us to be careful, like all these other red arrows. And when you get up to a really high reading, that means there are more puts on the, thinking about that fraction again, you got the numerator, the puts, growing versus the number of calls on the bottom. So if you get a 0.80 reading, it's like there are 8 puts being bought for every 10 calls. Down here at 0.5, it's 5 puts versus 10 calls. So here you're getting a lot more bearish. And again, this is a sentiment indicator. And so sentiment is a lot of times contrarian. So here, everybody's starting to get much, much more bearish in the market. And look at where these green arrows come in, usually to mark bottoms. So that's all it is. It's literally just a sentiment indicator. As sentiment goes all over the place in the market, it's just one indicator we use to help us in trying to determine whether or not we're at or near a bottom or a top.
Awesome information. So we got another question from Barbara. She asked, "Do you think politics are in play?" And then went on to say, Tom Lee from Fundstrat says inflation expectation numbers in the University of Michigan Sentiment Survey were skewed towards uh, something a little bit higher. They reported 3.6 inflation expectations, to whereas uh, there was a Republicans report that reported zero point 0.1 inflation expectations, 0.1%. Then she goes on to state jobs numbers may have been stuffed by government jobs. I don't remember this name, don't remember the guy's name, but a guy on CNBC was claiming there was only 122,000 private payroll jobs.
Okay. Yeah, I mean, I don't get into all the politics. I just don't. I look at the numbers that come out. I can go out and I can sense the economy. I mean, I know that there's inflation out there. I've been to the grocery store. I've been to gas pumps. Now that's the volatile sides. That's more headline inflation, but also know rents have gone up. I know my car insurance over the last 2 or 3 years has skyrocketed. I know when they talk about components of inflation, I can feel those myself. I don't need, somebody to tell me on CNBC whether or not there's inflation out there or not. I follow the numbers. I mean, I follow the charts. Again, I don't get into the politics. I've got a long-term study. The only political study I've ever done was to see what happens when a president, Republican president's in the White House, when a Democratic president is in the White House, when they have split, when the House and Senate is split, or when the House and Senate is aligned with the presidency. Like, if the House, the Senate, and the White House are all Democrats, or if they're all Republicans, that's generally what you have to worry about in terms of politics. And as far as everything else goes in politics, I don't care. I don't care whose opinion, and doesn't matter. Everybody's entitled to their own opinion. I just look at the numbers and I see inflation, which was 6.6% or 6.7% at the core level on CPI consumer inflation. And that's dropped down to about 3.3%. It's dropped in half. I talked about when inflation comes down, historically, the market goes up. So as inflation came down, what did we see? Market went up. I'm not seeing any movement in the market that tells me inflation's a problem. I don't believe it's a problem. I think it might be a little stubborn for a period of time, and maybe that's going to cause some people in the market to have ulcers. I don't know. But I believe we're eventually going down to the 2% level. And so I'm not really paying much attention to inflation.
Right. We got another one from our guy Ed. It's he got one comment and one question. We'll start with the question. So he's wondering about your IWM projection, given the small caps repeated underperformance versus the SPY lately, Friday's action and the jobs report. More. And in interest rate implications, can you ask if Tom still is committed to his 50% increase on small caps in 2025, 2026?
Yeah, I mean, it's been frustrating for me because I do feel like we've had periods over the course of the last year when the small caps have taken big leaps on an absolute and relative basis. And if you look back to where we were at the end of 2023, the IWM is at 160, and now we're at 228. So there's no question small caps have been recovering. They definitely have struggled relative to their larger cap peers, the S&P 500 and NASDAQ 100. I see that kind of shift back and forth. So for instance, right now, I believe we're still above on a relative basis. The IWM is still outperforming the QQQ and the Spider since that huge June CPI report came out. I think it was around July 11th of 2024. Since that time, I think that the IWM has outperformed, although I'd have to go back and double check just to make sure. But I think it's part of a longer term period of outperformance. Now, if you go throughout this whole secular bull market, you will see that the IWM relative to the QQQ, which has been the leader, Mag 7 stocks, growth stocks, technology stocks have been the leader throughout the last 12, 13 years. So the IWM small caps, which invest mostly in healthcare and finance or financials, little industrials, they're going to underperform. So this isn't a call for like a long-term period. It's a short-term call because I think the IWM has been underperforming for a long time, and I think they play catch up. But if you look at this same chart, which goes back 25 years, IWM versus the QQQ, look at what we have. IWM underperforms. So again, I'm not looking for anything long-term. What I'm looking for is one of these pops like we've seen in the past. And there's that low on the IWM. That was the July low that I was referring to. So we're still above it. So it's very possible that this is still going to move higher. I've said before, if we go and we break down to new lows with all this new information, then I'm going to have to rethink what I came up with. But one thing that I'm following is the channels that we've had off of the financial crisis low in 2009. And all of the major indices have these channels that have lined up. Right now, the S&P 500 is right near the top of its channel, telling me that maybe the upside, I'm thinking we have upside, but I don't think it's going to be rip roaring to the upside. The NASDAQ, when I looked at that, let me see if I can find you. Here's the NASDAQ's 15-year channel. So it went outside of it at the end of 2021, which was a big problem, which is why one of the reasons why we had a cyclical bear market in 2022. But if you look at the NASDAQ right now, we still got quite a bit of room to the upside to go back up and hit the top channel line. So I think we have a little bit more room there. But if we go back to the IWM, this is where we're sitting almost right on this center line. And so there's a lot more room to the upside because we've been underperforming for so long. And I take this chart and I combine it with the fundamental information that I'm very aware of with Fed funds rates coming down. I think they're going to continue to come down. There's some in the market that think the Fed should be raising rates because they're worried about inflation. I think they're worried about the ghost of inflation personally. I don't think there's an inflation problem. I think there is maybe there's a little bit of a struggle that's going to continue to take place on inflation in the near term. But I don't see anything at this point that worries me about inflation. So that means to me, those short-term rates are going to come back down, or they're going to continue to go down. We've already had, 100 basis point drop in the fourth quarter of 2024, 3 rate decreases, 50, 25, and 25. The Fed is still calling for 2 more rate decreases, and I think they could up it before, we get far into 2025. I think they could go back to their 4. If we start to see inflation, which we just saw last week, coming in below expectations, all of a sudden the conversation will turn again. But for right now, I see rate cuts coming. I see the 10-year Treasury yield still remaining somewhat elevated because I think our economy is still strong enough without long-term worries about inflation. I think that long-term worry will continue to dissipate. And so I see a really good environment for small caps because of the small banks that are going to benefit not only from that spread increasing, that's the lifeblood of a small bank. I audited small banks. That is the lifeblood. I think they're going to get pumped with a lot, it's going to be a blood infusion, if you will, over the next year. And I think that's going to help, but also deregulation. And that might ultimately be what causes a market top somewhere down the road, which it leads to our, market topping and secular bear market taking over maybe in another 8 or 10 years. But I believe we're going to go higher with deregulation. I think that's going to be another thing to improve. So anyway, yeah, I'm sticking with my forecast answer. That was a long answer to a tough question, a good question, but a tough one. But yeah, I think we go higher for those reasons. Now, again, if the IWM versus the QQQ and the IWM versus the Spider break down again, then, we're going to have to revisit. But for right now, I'm sticking to it.
Sticking with Ed. When the market was bottoming a few years ago, Tom showed a chart of accumulation taking place after the early morning sell-off. He hasn't shown that lately. Perhaps it'd be more useful coming out of a bear market, but I'm wondering if it's relevant now.
Yeah, I am too. Um, I'm following. This is the chart of the QQQ back in 2022 as we started to go down. And I just went back. I did a lot of research, a lot of studying of this period. And what I noticed was when we first went down, you could see at the beginning, before we even took the move down, we kind of went sideways right toward the end of 2021. But if you remember, there was a lot of rotation during this period away from aggressive areas and into defensive areas. There was also bearish manipulation on the QQQ, where we saw pretty good market action at the opening bell and in the first half hour of trading. And then the rest of the day was down action. So, yeah, we were flat, but we had, in the mornings, things were going higher. And then in the afternoons or after 10 a.m., the market lost ground. So it was like buy in the morning, sell in the afternoon. That's not a great feeling. I mean, I like to see the market being bought in the afternoon. So as I look back, I thought that was a little bit of a warning, which again led to me calling, one of the reasons that led to me calling the cyclical bear market in 2022 at the beginning of the year at our market vision event. And then what we saw in the first four and a half months was as we were moving lower in the QQQ, we saw throughout the entire day, the net gaps were down $29. The net action in the first half hour, the QQQ is down $35. 10 a.m. to 11 a.m., down $33. From 11 a.m. to 4 p.m., down another $14.50. In other words, they were selling all day long. That was distribution. That was just pure, let's get the heck out action. And then we got into this bullish manipulation phase where the market, the QQQ kept going down. But during this period, the gaps and the first half hour of the day, the QQQ was down $69 for this period. But from 10 a.m. to the end of the day, we rallied $43. So yeah, net, we went down probably 17, but it was a completely different animal. All of a sudden, it was gap downs. It was people afraid at the opening bell. We were getting all this news and on CNBC, and futures were down over and over and over again. So we were getting these big gap downs, and then we would see early morning selling, which to me was just lining the pockets of market makers. As everybody wanted to sell and was panicking out, market makers were taking those shares, and you can see it by the buying that took place after 10 a.m. in the morning. And then once we had this final bottom in place right here, double bottom, this is when the new bull market began. And look, after 11 a.m., the QQQ during this phase after 11 a.m. went up $73. And the whole period was pretty much up. But you can see after 11 a.m., there was just nothing but buying, which to me was very bullish. So that was kind of the anatomy of that cyclical bear market back in 2022. And so what I've been trying to do is apply that to the IWM, and it hasn't worked as well, I'll be quite honest. And so it's giving me less confidence in this kind of an analysis. And maybe, like you asked, maybe it is a bear market that it works better in than during a bull market. I don't know. But for whatever reason, and usually this also coincides with the AD line. If you notice what the AD line's doing, kind of what we're looking at here is similar to how the AD line is calculated. So, and if you look at the IWM AD line right now, it's very weak. It's nothing like the QQQ or the spider. So, yeah, there's still some question marks out there for me in terms of whether the IWM is going to outperform. But for now, until we see a breakdown, I'm going to stick with the theory. And as far as the intraday stuff, I'm continuing to follow it just to try and learn more about it. But it certainly has not been providing us the really solid signals that the QQQ provided us back in 2022.
So we're moving on to Greg.
Mm-hmm.
We've never heard this acronym before, but we called it ANMAG. But he was asking about Apple, NVIDIA, Microsoft, Amazon, and Google. ANMAG.
And MAG, okay. Well, I don't really like to get into doing individual stock questions. I mean, if I went through individual stock questions from all of our members, we would never end this session. But I'll go ahead and make an exception today and look at these five real quick because they are five of the more popular stocks and stocks that I'm invested in to some degree, and probably stocks that are in most everyone's portfolio, either individual stocks or maybe through ETFs. So with that in mind, let's take a quick look at them. I'm just going to pull up the daily chart. I can tell you these stocks long-term have great long-term charts. So let's just pull them up one at a time on a daily chart. So Apple is trying to bounce back here on this daily chart. It is gotten down into an area where I think there's pretty good support from 215 to 220. So short term, I'm kind of watching that level. NVIDIA, as I pointed out earlier, has taken out the highs from back in June, July. It just mostly sideways consolidation, but I think threatening to try to break out again. I see NVIDIA going higher. I really love the stock. It's one of the best performers in the semiconductor space. I wouldn't bet against the company. So This one I have no problems holding long term. In the meantime, in the short term, 130, 128, that's your short term support, and then 153 is resistance. But I'm looking for a breakout probably sooner rather than later. A lot of it will depend, I think, on what happens with the U.S. and China regarding President Trump and his tariffs. This is a group, semiconductors, that got hit really hard back in the fourth quarter of 2018 and really led that cyclical bear market when we went through the trade war with China. So this is a group that's very sensitive to that. We could be looking great one day, and then all of a sudden, something comes out regarding tariffs, and you could see big moves in this group. Either way, if the tariffs are a little lighter than what the market was expecting, we could see this become a major catalyst for a huge advance in semiconductors, because I believe that the tariffs are part of what's been keeping the many of the semiconductors down or led to outright selling in some semiconductor stocks like Applied Materials, which I know has direct ties to China. Um, anyway, we'll see how that all plays out, but that's the wild card as far as I'm concerned going forward with NVIDIA and many of the semiconductors. Microsoft just been going sideways, consolidating for a while. But again, you got to keep things in perspective. Microsoft had a huge run to the upside. So it's fine to consolidate, let the fundamentals catch back up to price action. I see Microsoft going higher in time, but I can't tell you when it's going to be. I suspect we'll probably see a breakout sometime in 2025. Maybe it'll be next week or next month. Maybe it won't be until later this year. I don't know, but I do like Microsoft to go higher. Amazon, I love right now. I think that they made a breakout after 4 years of consolidating sideways. This breakout that occurred back in November, we pulled back to this 198, 200 level. We broke out again, and look what we're doing right now, breaking out again over the mid-December high. Amazon is one of my key stocks in my portfolio. I really like the stock, and I think it goes higher. Google, since probably the last month or so, since we made this move in mid-December, I've grown much more bullish Google. This is another one that long term struggled, but it's just making a breakout to all-time highs, and I believe that we're going to see a strong 2025 with Google. So that's my what was it? ANMAG.
And Mag.
That's my ANMAG
Yes,
review.
I love it. So we'll stick on. We'll probably see one of these stocks again with this question from Dimitri. Which Dow Jones stock has the best setup for 2025? Putting your long-term hat on.
Well, it depends on a lot of things. So recently I did this Dow Jones components chart list where I listed all 30 stocks in order of their weighting in the Dow. So now it changes all the time because the weighting is based on the stock price. Unlike the other indices where the weighting is based on the market cap, their market cap weighted indices, the Dow is a price weighted index. So you can see that the higher weighted stocks in the Dow are the ones that have the highest stock price, which is important if you didn't know that, because the Dow is obviously going to be carried by Goldman Sachs and United Health, Microsoft, Home Depot, Caterpillar, and Sherwin-Williams. You might think that it's Apple or Amazon because they have the highest market caps, but it's not. Apple is 12th in terms of the weighting in the Dow, and Amazon 17th. So if I'm looking purely growth, I just said I really like Amazon. It would be hard for me to go against Amazon. Somebody who's willing to take more risk, but wants maybe perhaps a bigger return, I think Amazon looks as good as anything. Now, if you're more of a long-term investor and you want to keep an eye on dividends and maybe a little bit more of a value trader that maybe looks for a Dow stock that's pulled back a ways and might be offering much more value and a higher dividend, then I would go with, there are probably a few of them in here, but one that I would go with would be, let me see if I can find it, Merck. Now you can see on the monthly chart here, it's been going down. It was over $130 stock. Now it's 96. So again, from a short-term perspective, if we look at Merck on a daily chart, which I'll do right here, I mean, AD line looks horrible. Look at this price action. It's been awful. You know, who in the heck wants to buy Merck? So again, it's a trader's perspective versus maybe a long-term perspective. But if we go back and we look at this monthly chart, what happens when Merck hits its 50-month moving average? And what happens when Merck gets close to its um, PPO, you know, the monthly PPO, when that gets near zero? What happens that when those two things happen? And what happens when Merck has its monthly RSI in the 40s? Go back and look at history. Um, you know, I mean, here, 2015, we had monthly RSI in the 40s. Here we hit the monthly, you know, that 50-month moving average. And here, a little bit later into 2016, we got the monthly PPO down near zero. So it was kind of like right in this range was when it was a great time to get into Merck. How about 2017 into early 2018? There you go, 50-month test, PPO near the center line, monthly RSI in the 40s. What would have happened had you bought right back in here, end of 2017, early 2018? You'd have been really happy the next year or two in Merck. And so we dipped a little bit here into the 40s, got close to the center line here, and touched the 50-month moving average here. That was in 2021, and we went up from there. And now we look at where we are on Merck. And by the way, these last couple of years, we went from 65 to 130. Merck doubled in 2 years prior to this pullback. You got to have some perspective when you look at charts. You can't just look at the last year and say, oh, it's a dog. Well, part of the reason is that Merck doesn't go up like Netflix or Google or Amazon or, you know, some of these small Palantir. You know, I mean, the earnings are more measured. You're not going to have the volatility in earnings over time. They're going to pay out more in dividends. More of their earnings are going to be paid out in dividends versus reinvesting in growth, which is what Palantir and many of the other companies I talked about have done over the years. So this company went up 100% in 2 years. And so, yeah, it's had a nice little pullback, but it's still in a nice uptrend. So again, I think when you look at the Dow and you say, give me the best stock, you know, I think it comes down to perspective and the type of trader you are or investor. I think a long-term investor, I like Merck. I mean, it's going to pay you 3 or 4% dividend. I think it might be around 3.5%. It's come down to a level where, like I said, this is a level where historically this is where you want to get into Merck. So I could make an argument for a number of different stocks in the Dow, but for the two reasons I gave, one being growth, I like Amazon, and then more value, maybe a higher dividend, and that sort of thing, I like Merck.
Awesome. So we got a new member question from Dariush.
Okay.
Um, it's a Max Payne question. He said, how can the information on the Max Payne list be used? Can I see an example of a relevant use?
Well, I think probably the most relevant use would be look at my Excel spreadsheet and just look at the middle of the month historically. And you can see that let's stop share. I'm going to go back over to that Excel spreadsheet that I was showing earlier. So let me share that. So you should have this up now on your screen. And if I go to the bottom of this analysis on the S&P 500 after December, I have this. It's like I group all the first days of all the months together. So it would be January 1st, obviously holiday, February 1st, March 1st, April 1st, all the firsts. This is how they've performed since 1950. Then I do the seconds, then I do the thirds, I do all the way through the month. And then I come up with this period right here, or breakdown in periods, where I look at the 26th to the 6th of all calendar months and look at the annualized performance, 21%. I look at the 7th to the 10th, minus 3%. That period since 1950, you know, this is 2,515 trading days, which is like 10 years worth of data. You might look at it and say, well, it's the 7th to the 10th. It's only 4 days. Well, it's 4 days every month out of every year for 75 years. So a lot of days get added up. So if I told you for the next 10 years that we were going to go down 3% on the S&P 500, that would be the equivalent or even worse than a secular bear market. That's what occurs every month. You don't even know it because you're just constantly going through the months. But the 7th to the 10th is a bearish period. Then you got the 11th to the 18th, which is very bullish. And then look at this 19th to the 25th period, minus 7.23%. And this is over 4,275 days. So this is the equivalent of about 17 years worth of data. So worse than that 7th to 10th period, if I told you that the 19th to the 25th, if I told you were going to have 17 years of the S&P 500 going down an average of 7% per year, how excited would you be to invest over the next 17 years? Probably not very excited. Well, that change right there, that average performance, in my opinion, based on everything I've seen, I believe that relates back to option expiration week, monthly option expiration week, which always is the third Friday of the month. And if you look at a calendar, that means that the third Friday of the month has to finish somewhere between the 15th and the 21st of the month. I can tell you that the worst day to be invested in the stock market historically, not every time, but over time, is the Monday that follows monthly option expiration. So if the Friday option expiration is the 15th to the 21st, then the Monday that follows is the 18th to the 24th, right? So 18th to the 24th lines up almost perfectly with this 19th to the 25th time frame. So what I'm telling you is, forget about all the numbers and the calculations of Max Payne. What I'm telling you is that stocks have a tendency to go up into option expiration Friday. And as they get closer to that period and then into the early part of the following week, the market has a 75-year history of coming down during that period. Not every month, but if you have a big period leading up to monthly option expiration week, I would be more cautious than normal going into that week. So I'm just taking a big approach, not necessarily looking at the calculation of the individual calls and puts. But to me, this more than anything else embodies how risky it is to be in the market during option expiration week and a few days following. So I will leave that at that. I think that's a pretty compelling argument.
I would agree. All right, moving on. We got a macro question from Todd. Uh, I've come to see that when the U.S. dollar fund UUP goes up, emerging markets and foreign ETFs get smacked and fall badly. When the dollar ETF goes down, the emerging markets reverse and go up immensely. How should we evaluate the ETF UUP uh, going and rolling over, or going up? It'd be awesome to have your thoughts on it.
All right, so let me pull up another chart that I think I already had set up here. So here's the S&P 500 over the last year. Here's the dollar over the last year. And this is another thing. You want to talk about inflation? Everybody's worried about inflation. Inflation eats away at the dollar. Who in the heck would be driving the dollar up right now if we were really truly worried about inflation? This wouldn't be happening. The dollar normally gets hit during a period of inflation because it erodes your currency. Anyway, just wanted to point that out as a side point regarding inflation. So when I talk about signals are telling me don't worry about inflation, this is one of those signals. But if you look at what happened, so I've got the S&P, I've got the dollar, then I've got the German stock market. This is the DAX going up, and you can see it's been going up. And then I've got the EWG, which is the ETF that tracks the German index. Now, the thing you have to understand about the EWG when you look at it, you're looking and you're saying, okay, it's going up, it's going up. German's kind of going sideways. The DAX is going sideways, but during this period, the EWG is going way down, much further down. It tracks the German index. You're like, what the heck's going on? Well, back to your point, that's a great question. Everyone needs to be aware of this, especially if you trade ETFs on foreign indexes. So the dollar plays a role in the return that you're going to have in those ETFs. So in this case, look at the dollar taking off in the months of October and November and even into December. Dollar's been going straight up in the fourth quarter. The DAX went up, but look what the EWG did. It went down. So if you're thinking, okay, I really like the German DAX, and you get in on October 1st, the DAX is around 19.2 at that point. At the end of the quarter, the DAX is at 20,000. So you've gone up 750 points, and you're saying, okay, that's about 4%. But if you got into the EWG to benefit from that, you got in at probably around 33.50, and at the end of the year, it was 31.50. And you're like, wait a minute, the DAX went up 4%. Why am I down 6% or 7%? The dollar is why. The surge in the dollar, the currency effect on owning a foreign ETF is what took it down. Now, look at this period, July through September. So this is the third quarter. The dollar went down the whole third quarter, right? The DAX right here went up slightly into the third quarter. I mean, the DAX went from, let's see, right here, which was at about 18,300, and it was up to 19, let's call it about 19,200 at the end of the year. So it went up 1,000 points, which is probably, I don't know, 5% or so. But look at the EWG. So we went from probably about 30.70 to 34. So we went up 5% in the DAX, but actually, no, we didn't go up to 34. That's the end of, end of September. That's right. So here we went up 5%, and here we went up almost to 34 from 31 and a quarter, or no, 30.75. So what's that, 10%? So here we went up double what the DAX did. The reason? The dollar went down. So yeah, the dollar plays a role in these ETFs, and you can pull up just about any foreign ETF and the underlying index and put it on a chart similar to this, and you should be able to see that relationship.
So we're moving on. We got another newer member. I think he's been around for about a month or so, Daz. He was wondering how you set up on your chart the stock relative to its industry group and the industry relative to the sector. Basically, like how you set up your normal charting.
Okay. Well, here's just my basic chart. So it doesn't have any of the relative ratios on it. So let me just show you how I would adjust this chart down here manually. Now I have these style buttons over here, so I can go to it really quickly, and I can go from JP Morgan. These are just saved chart styles. And I think there was a question about this somewhere, and so I'll get
Yeah,
back into this a little bit later.
absolutely.
Yeah, but if I click on this, I got my relative chart 1 year. So the way I've set this up is the AD line on top. There's the price action. Here's JP Morgan relative to banks, and here's banks relative to the S&P 500. So I think what you're looking for is something like that. So let's go back to this regular chart. This is just my default chart. I got the PPO price action. I got the RSI. And let's change it to make it look like that other chart. So the first thing I would do is I would change the PPO to the AD line. So now I've got that up there on top, make it a height of 1.0. So it's a bigger chart up there. I don't need it to do that, but I just set it. Anyway, down below, what I want to do is I want to use price. And right now the default is the S&P 500. But what I want to do is I want to find JP Morgan relative to banks. Now I could type in JP Morgan colon $ DJUSBK. The problem is if I do that, if you go up here, well, let me just go ahead and show you what will happen. So, let me do this 1.0 over here. So this is going to be JP Morgan versus the bank index. Now let's say I want to look at Tesla relative to the autos. So here's Tesla. And because, it's Tesla here and it switches down here to Tesla instead of JP Morgan. So it does follow whatever you type in there in this price in the parameters. You can see Tesla, it changed from JP Morgan to Tesla, but it didn't change from banks to autos. And so now if I don't make a change, I'm looking at how Tesla's doing relative to the bank index, which makes no sense, right? So what I'm going to do is I'm going to go down here and instead of actually putting in the symbol, which isn't a big deal, you can type in dollar symbol. That means whatever the symbol is you type above will come down here. And then you can do it. I've got the default coming up here, but it's dollar symbol colon dollar industry. And if you type that in and hit update, now you've got Tesla versus the automobiles. And if all of a sudden you wanted to look at NVIDIA, it will automatically change to NVIDIA relative to the semiconductors and so forth. So that's how you can make that change. So it's symbol versus industry group. And then if you wanted another one where you have industry group versus, say, the S&P 500, then you can come down here and just say, give me the dollar industry versus the dollar S&P 500. And now you've got this set up. Let's put it 1.0. And let's make this chart a little bit bigger.
Hey, Tom,
Yeah.
is there any way you can add let's say like internet versus communication sector?
Um, oh, you're looking like at industry versus sector.
Yeah, yeah.
I think you can. I don't usually do that, but if you'd pull up symbol, and I'm going to try sector. I don't know if this works or not, to be honest. Oh, I'm not seeing it. Oh, I didn't put in price. So let's
Gotcha.
do this. Let's do symbol, and there's $ sector 1.0, and there it is.
Wait,
So that's technology though. So I would have to, not symbol, I'd have to come down here and use industry.
industry. Yeah, there you go.
Or no, yeah, industry versus
Yeah,
sector.
industry versus sector. Yeah, nice.
Okay. Let's try it. Should work. So semiconductors versus technology. So let me change it to another area. Let's do restaurants. Let's do pull up CMG, Chipotle. So now if we do Chipotle, we got the AD for Chipotle, we got the Mexican grill there, we got the price action. Now we've got Chipotle versus restaurants. Then here we've got restaurants versus the S&P 500, and then we've got restaurants versus consumer discretionary. So we got it all. So
That's
there you go.
awesome.
If you want to take a picture of that, I'll
Yeah.
just leave it here for a
Well,
second.
would
But that's
you
how.
also go over how to save that in your small little rectangles, your chart styles?
Oh, over here.
Yep.
Okay.
So
So
if you
let's
wanted
say
to
we've
add
got this style up and we want to save. Um, I could come over here. This plus sign means you want to add a button. Okay. So if you want to edit, you can hit this little greater than sign up here. But if you want to add something, you can go right here and add. And I think the number of style buttons you have is dependent on your membership level at Stock Charts. So I think, I'm not positive, but you have to go back and double check that. But I'm a pro member, so I'm sure I could probably add another one without any problem. But what do we want to call this? Let's just call it stock sector or stock industry sector. SPX. So I'm just going to call it what it is. Basically, we're looking at all this stuff: stock versus sector, or stock versus industry group versus sector, and sector versus S&P, or whatever we have on here. But anyway, hit this add new. So once you've titled it, hit the add new. The only thing I don't like is it'll go back and it'll sometimes, yeah, it's reordered my style buttons, which I don't like, because then I have to go
You
back
can
and
drag them
order them.
around to edit though.
Yeah, so I can edit and get it back into the order I want. So see, it's after daily is monthly. So now I got to go down here and grab this weekly and drag it up to monthly. Um, and I like my upcoming earnings to be next. And then my upcoming earnings are S, relative strength. And then I think, yeah, I think the rest of that is in order of what I typically use. And so then I go back, and then it should all be set up in the order I wanted. And then you can just, if you hover over it, it'll tell you which chart it is. And so here I'm going to go in and grab this stock. Let's go to another stock, do Palantir. And I'm going to hit this stock industry sector SPX. And now look at it. It's set up just the way we set it up. So
Awesome.
that's all you have to do. So you got a lot of shortcuts at stock charts so that you can get one thing that I if you're an investor, you might want to look at something like what's a good dividend paying stock right now, like Pfizer. I know that pays probably 6% or more. But you could come down here and change RSI, or just you can keep the RSI and just do another indicator. But if I just change RSI to dividends, and maybe I want a long-term chart, so I want a monthly chart. Maybe I want this thing going back, 15 years. And then I hit update. Now what I've got, let's make this 1.0 again. And might want to make this a little bit bigger. Oops, I don't think I hit the bigger. There we go. So now I've got Pfizer monthly chart, PPO, and look at the dividends. I got the dividends charted on here for me. So basically every year companies raise their dividends, and then they pay out a steady 4 quarters, and then they raise again. And so you can kind of see beginning of the year is when we typically see a raise in dividends for Pfizer. But if you're long term, this is a kind of a chart list or a style that you might want to keep and add, dividend style or whatever you want to call it, long term dividends, monthly dividends. I don't know, put a name on it. So that's anyway, took a long time answering, but that should give you some additional insight into how you can flip things around over at stock charts.
Absolutely. That's some great information. So moving on, we got the put call ratio question from Jeff. He said, I had a alert trigger after the close today, and I guess he emailed in a couple days ago. The long-term 253-day average of the CSCE equity put call ratio was down under 0.62, which is where it bottomed from the sell-offs in late 2018 and the COVID crash in March 2022.
Yep.
Just
So,
basically, he's wondering what your thoughts are on that. He said he's been watching it since you mentioned it a couple webinars ago.
yep. Still going straight down. It's shown no signs of turning back to the upside. The turn is what you want to see. And I'd like to see it maybe, show up at the same time. Maybe we're seeing some long-term negative divergences on, say, the weekly chart on the major indices. I mean, if you start seeing slowing momentum and, we've reset, we've gone from being very bearish in the options world to being very bullish or complacent. You start adding things together, and that's how, in my opinion, you can get a story. The charts all of the different signals will start telling us a story about, hey, risks are growing. And even back in 2022, I never came out and said, we are going to have a 25% decline. What I said back then was that we got a lot of red flags building. And so the only thing missing is for the stock market to start rolling over and seeing price deterioration. And that's what we saw at the beginning of the year that confirmed all of the signals. I'm not sure where we go with this. I mean, we have looked at this in the past and we've said, okay, here's a bottom. Excuse me, in 2018, that was at what, 0.61. Here was a bottom at 0.58. Here was a bottom at 0.58. Here was a bottom at 0.59 and change. Here was a bottom at 0.46. I don't know exactly how far it's going to go. I mean, we're in a secular bull market. And so my guess is that people will continue to be bullish. I suspect we'll probably go down at least to this 0.58 level before we'll start to see any kind of a turn to the upside. Um, and even a turn might just be temporarily. We have seen a couple of those, mostly around the pandemic. But we saw a little turn to the upside, then back down, then back up. This would have been a very difficult time to call. But you can see for the most part, this once it gets going in one direction or the other, the stock market goes in the opposite direction. So in other words, when the fear is building, the market's coming down. Once we've gotten so high and so much fear for so long, the market has nowhere to go but one direction, which is back up. So I always talk about this resetting. That even when we went into that 2022 Market Vision event, right here, I said that most important signal to me, or one of the ones that was really worrying me a lot, was the fact that we had this period of bullishness and folks just jumping into calls like they're printing like it's an ATM machine printing cash for them. And that's a problem. And that was all the new investors that came into the market after the pandemic and people had to stay at home. And we got a lot of new investors coming in that thought, hey, stock market's easy. All I got to do is just keep buying calls and I just make all this money. I can go into Wall Street, whatever what was it? Was it Reddit or there was another Wall Street
Street
bets?
bets. Yeah.
Yeah. So all I got to do is go in and listen to those guys, not just go buy options, and money's just gonna be falling in my lap. And unfortunately, the market when we get to those levels of euphoria never ends well. And so we had a whole new group of investors that learned the hard way what the stock market is all about. And so eventually, right, we're going to get to that point. But what I said is when we turned on this and started coming back down, look at the rally in the market. And it happens every time. Every single time this is coming down, you want to be in the market. 40, 50, 80, 100% returns, sometimes in just a little over a year or two. Market only normally goes up 9% a year. So pretty important to hit in these areas. But the problem is mentally, when these periods start, everybody's fearful. Nobody wants to get in the market. So you got to be that contrarian. You got to take positions and have conviction when nobody else does. And so anyway, we're moving in that direction. Um, Now, every time we get to a low doesn't mean we're starting a secular bear. Keep that in mind. Sometimes we just go into a cyclical bear and we'll see it reverse. So don't think of this as, oh my gosh, we're getting so low. We're going to have 12 years of bad market action. That's not the case, but it could set us up for another cyclical bear market sometime later in 2025 or in 2026. This is something we'll continue to watch for a while.
And we got a newer member as well, Anthony here. He had a handful of questions. They're relatively quick though. So do you take consideration just the candlestick bodies or the wicks too when drawing trend lines?
All right. Well, let me think of, I mean, I could probably pull up just about anything, but um, let's pull up the bank index. I don't know. Maybe we'll be able to draw something there. I mean, trend lines are subjective. Price is not. Price is very objective. I can tell you on a certain day whether we're getting a breakout or not. I can look back and tell you exactly where the prior high close was or where the intraday high was. And if we go above it, there's no disputing. It's a breakout. Might be a failed breakout, but it's a breakout. Trend lines are different. Trend lines, you've got, first of all, you can look at a trend line on a 5-day chart. So let me just pull up a 10-minute 5-day chart on, maybe go a little bit further. Maybe we'll go 15 days and see if there's something we can kind of draw a line. So here's, I just see trend lines and channels misused so much in the market. But let's just say we're looking at this channel or this trend line right here on banks. Clearly, we have a lot of tests as we go up. Let me bring this in just a little bit. There we go. And I'll kind of scoot in here so everybody can see it a little bit better. So here you go. So from January 13th to the 21st, you look at this trend line and you say, wow, look at all these tests. Every time we come down and we hit this, that's awesome. And then we see this breakdown on January 22nd. And someone will look at that and say, oh man, this is really bearish. Look, we've lost this trend line. Well, first of all, it's a 1-week trend line. I mean, what is it, 7 days, 6 days? And we ran from 645 or 650 up to 710. We went up 10% in 6 days. How long do you think that channel or that trend line is going to last? You think the bank index is going to go up 10% every 6 days? Because that's what it's got to do in order to keep this trend line going. So trend lines to me are great, except you got to keep things in perspective. So let's, we're looking at this as being banks. Let me go over here and let's take a look at now at an hourly chart on banks. So we pull up an hourly chart and we just pulled up this, January 13th to January 21st thing. But, I see it here on the hourly chart, but it's not as easy, in my opinion, to pick up. And certainly if I were to go to a daily chart, I mean, do I really see, is this a channel that's something that you should rely on for a long period of time? Of course not. We can't go up 10% every 6 days. And the daily chart definitely makes you realize that. How about the weekly chart? It's got a really nice long-term channel in play, and we've broken out to 5-year highs. So right now, banks look to me to be extremely bullish on a long-term chart. And then I go to a daily chart, and it looks like I'm getting a breakout above the recent high. That looks pretty bullish. Hourly chart, now we have negative divergences here that maybe we need to be a little aware of. But a negative divergence on an hourly chart means that we could go back 1 or 2%. I mean, and the negative divergence would be gone. So a negative divergence on an hourly chart is not nearly as important as a negative divergence on a daily or certainly a weekly chart, because that could lead to a lot further selling. You have to understand what period you're dealing with. So anyway, this is a long-winded, answer, but trend lines and channels and things like that really, I think you have to keep in mind perspective, because I mean, I've seen some really, really good analysts that I have a lot of respect for that will show a trend line on a daily chart that might be going back a couple months, and it'll break down, and then they start calling for stuff, really bearish stuff to happen. And I pull up a weekly chart and it's like, well, we could have a pullback to the 20-week moving average, and that wouldn't be horrible. I just think sometimes these channels and trend lines are given too much emphasis based on, sometimes it's off of a intraday chart or something. It's just keep it in perspective, number one. So then number two, the question is, do I draw lines with candle bodies or with, intraday lows and highs? And I would just say it's subjective. I don't think that there's a right answer and a wrong answer. I tend to try to use closes. Like I like channel lines and trend lines mostly on daily charts and forward, because if I look at this hourly chart, or even worse, a 10-minute chart, and I'm trying to draw a line, like I don't know, let me see here. I might draw candle bodies, and I'm trying to connect these two candle bodies down here, and they don't exactly line up there, right, with that move up there. But if I drew the line from this intraday low on January 20th or 17th, I should say, and I'm drawing it along the intraday lows, then it hits this line beautifully. So which one's right? I don't know. I mean, so what if I had it here and connected, the bodies, which then come in a little bit lower over on this right side. So if the next day, if it had hit this, should I have bought? And then does that mean I should sell when I lose that trend line? Well, first of all, the timing of losing it is dependent on how you draw the line. And then number two, you're talking about a 2-day trend line. I mean, really? I'd have to be a serious day trader to be using channel lines on a 5-day chart. To me, channel lines aren't as useful on short-term charts as they are on the longer-term charts. So I don't know if that helps or clears things up or not, but I would just say my answer would be it just depends. I mean, you're trying to connect, you're trying to make two things look like a channel, and that channel could be like this, going up, or maybe it could be tweaked just a little bit steeper, or maybe just a little less slope. I don't know that there's a right or wrong answer. I would just say my preference is to connect daily lows or daily opens and closes, because that is where the market pauses. That's where market makers either establish opening prices or establish closing prices, and we actually have a close and an open. That's what candlesticks do. They're giving you visuals from, they give you a visual of open, close, high, and a low. And but daily chart's the only one that really has an open and a close. An hourly chart, the market doesn't close at 10 a.m. in the morning and then start right back up again. It's just continuous. So you don't really have an open at 10 a.m. on an hourly chart or at 10-minute chart. You still only have opens and closes at 9:30 and 4 o'clock. Anyway, hopefully that helps.
So I don't know if you follow this. Do you have an opinion on the Chante trend meter indicator?
No,
Chandra.
never. Yeah, I've never used it. I know he used to write, had a blog over at Stock Charts, and I think he even came on to our, um, when I used to do the host the show. What was it, Market Watchers Live or Market Watchers something over at Stock Charts, and Aaron Swinland and Mary Ellen McGonigal would co-host with me sometimes, mostly Aaron. But anyway, I think we had him on the show, and I used to know a little bit more about it because he would come on and talk about it. But I think if you go down under indicators, there it is, the Shande trend meter. I mean, I'll pull it on here. I couldn't tell you exactly what it was. Yeah, I do remember this green and red. I'd have to go back and study it. It's not an indicator that I use, and as a result, I just don't follow it. I try to keep my charts simple. There are some charts, God bless the technicians that can have 40 indicators on one chart. I look at it and I just get a headache. It's like, well, this says I should buy, this says I should sell, this, I don't know what this says. This line's crossing this one, but then there are 4 other lines going in between. And I just look at it. It's just, analysis paralysis. I just can't pull a trigger. So I like keeping my charts pretty basic. And there are some things that I understand, indicators that I understand really well. I know what their strengths are. I know what their limitations are. And so I can pull up a chart and use them and come up to a pretty quick decision whether I like a chart or I don't. I just can't do that with all these various indicators telling different things. And just my preference, I like to keep it easy. The KISS theory, keep it simple, stupid.
Love it. Tiger Woods.
Yeah.
So still sticking on to Anthony, are there any candlestick patterns that you would recommend learning first?
Patterns, candlestick patterns that I follow and that I like. Is that what it is?
Yeah, basically any that you would recommend following or learning.
Um, yeah, I mean, I love bottoming candles. I love candle patterns that confirm other things. Like if I'm looking at a key level of price support, for instance, actually I was watching Zoom today and I thought Zoom was an interesting chart. So Zoom got a low. You see how low it went down below this prior support level? Kind of zero in here on this over. This is down at around 77.50. And I know on the long-term chart, Zoom was struggling to get through 75, 75.50. I don't remember the exact number, but we went all the way up into the 90s. And now this pullback has occurred and we've gotten back close to 75. We actually put in a tail right below this low. And a lot of times that's a major bottom. So I'm looking at this, and the reason I bring it up on Zoom is, on the daily chart, we're trending below the moving average, doesn't look very good. But when you pull it up on a weekly chart, this is actually trying to print a hammer on the weekly candle right at the 20-week moving average, which I find to be somewhat useful. So, yeah, I love hammers because to me, that's where you're basically hammering out a bottom. We see intraday or intra-week action that's very poor, and then we come roaring back. Now, I prefer it on a daily chart versus a weekly chart for many of the reasons I talked about earlier, but I really like reversing candles. So I like the hammer. I like the bullish engulfing candle to reverse things at least for a short period of time. Let's take a look at something like Palantir. See if I can see one. It doesn't really go down much. There's an exhaustive, well, I don't even know that I call that exhaustive gap to the downside. You really didn't go down for that long. Just trying to see if there's a bottom. I mean, this isn't really a bottom, but if we looked at the end of September, early October, see how we went sideways to down here for a little while, and then right on the 20-day moving average, we get that bullish engulfing candle, and that starts that reversal back to the upside. So, hammer, bullish engulfing. Of course, at the top, for topping candles, the opposite of a hammer would be an inverted hammer or a shooting star candle. Opposite of a bullish engulfing at the bottom would be a bearish engulfing at the top, kind of like this right here. So we're going up, up, up. We get a bearish engulfing. We come back down for the next 2 days, close to the 20-day moving average before we reverse back up. So those are some of the candlesticks that I would say that I'm, mostly interested in.
I think that's some great stuff, Tom. So we'll move on. We've got some pretty quick ones. We got one from Jeff. He's wondering if there's an ETF for the Dow Jones Pipelines Index.
I have no idea. I mean, one
I
thing
was
that you can do, what was that, Matt?
I was looking, I couldn't find one.
Yeah, one thing you can do sometimes is just type in, and if there's an ETF that's a pipeline ETF, you might find it just by kind of stepping into it like this. But these are all stocks with pipeline in their name. Now, this is a Goldman Sachs North American Pipelines and Power Equity ETF. So GPOW, it's got almost no volume. I don't like trading ETFs or anything else with no volume because usually the bid and ask spread is just too wide. So I personally wouldn't do that. I mean, I'd probably, if I knew how much money I wanted to put into the ETF, I'd probably just find, 4 or 5 pipeline stocks that are, pretty significant players, look at their market caps and so forth. And the way you could do that is you could go into your dashboard, go all the way down till you hit sector summary, which is under summary pages. Hit that sector summary. And then under energy, you will see pipelines, which is right here. And if you hit pipelines, and then you can, if you have market cap up, you can just sort on that column. If you don't have the market cap up, you can go into the columns. You can always, put in different columns or take some out. So if you didn't care about, whether it was large cap, small cap, or whatever, you can take out that U. That takes out that column. You don't really need it if you know what the market cap is. But yeah, instead of buying like an ETF, there might be 4 or 5 stocks on this list that are pipeline stocks that are really large players. And maybe, if you were going to put 20,000 into an ETF, I mean, maybe that's too high for some, probably way low for some others. But if you're going to put 20, why not just put 4,000 into each of these 5 stocks? And then you basically have a pretty good diversification within the pipeline group. That's just something else to think about if you can't find an ETF that follows another group. But if I typed in something like software, for instance, there'll be the IGV. Here's the iShares Expanded Tech Software sector. and you can see that one's a much heavier volume traded ETF. And you could then go in and find the component stocks of the IGV, which I could probably tell you. So this gets back to know what you own kind of a thing. Bear with me for about 30 seconds. And if I'm looking at the composition, I'm looking at another computer at Fidelity. But they've got on Fidelity, if you sign in, they've got an area news and research. And if you go down that, there's like 5 tabs at the top, news and research. And then you go halfway down is ETFs. And then it'll come up, it'll give you a box to put in the ETF ticker symbol. And then you can, after you get that, you can then click on composition to find out what's going on inside that ETF. But when I look at that software, 8.6% is Oracle. 8.5% is Microsoft, 8.5% is Salesforce, 7% is ServiceNow, 6.5% is Adobe, 5.75% is Intuit, Palantir is almost 5%, Palo Alto Networks is almost 4%, Cadence Design 2.73%, CrowdStrike 2.6%. Those 10 stocks add up to almost 60% of the ETF. So just that quickly, type in the industry group that you're interested in. If there's an ETF, a lot of times it'll come up. Stock charts will suggest it to you. Pull it up. I like to make sure that it's, liquid, and then go into, in this case, Fidelity. I think you can get the same information off Yahoo Finance. You can probably get it off of your broker, whoever you use as a broker. They probably have a research area. And then find out what's in the stock or what's in the ETF. So, I look at the top 4, Oracle, Microsoft, Salesforce, and ServiceNow. Those 4 are probably they're more than 1/3 of the entire ETF. So you better like those 4 stocks if you want to get into IGF or IGV. So anyway, again, went a little bit off trail there, but just wanted to
I think
kind of
it's
give you
great
a little bit.
information either way.
Yeah, good information.
Yeah. So we got a seasonality question from Gary.
Mm-hmm.
He's basically wondering, when did Tom say the weaker months were?
Um, well, I mean, I usually follow that in the seasonality report. I know Aaron puts out a monthly seasonality report that gives some information on that. I mean, if you're looking at growth stocks, normally, let me pull up seasonality. I mean, I look at the 3rd month of every calendar quarter as generally being a little bit more challenging for growth stocks. So if I pull up seasonality, IWF is the Russell 2000 or Russell 1000 large cap growth index, and the IWD is the Russell 1000 large cap value index. And so if you go back over the last 20 years and you look at this, if you add up the first quarter of each month or the first month of each quarter, so January, April, July, October, if I add that going across, that's 0.6, 1.2, 1.5. So that means that over the last 20 years, the first month of the calendar quarter, IWF averages outperforming IWD by 1.5%. Then we get into the second month, which February, May, August, and November, and I come up with 0.7, 0.8, so that's 1.5, 0.9, that's 2.4, and then 0.2, 2.6. So in the second month of the calendar quarter, and going back 20 years, growth outperforms value by 2.6%. In those months within those quarters. Now let's look at the third month of each calendar quarter: March, June, September, and December, and I get 0.3, 1.0, so that's 1.3, minus 0.3, that takes us back to 1, and minus 0.4 or zero point 0.5 takes us back to 0.5. So the outperformance of growth stocks slows generally during those periods. And if you look at the number of times that growth outperforms value, the two worst months, March and December, in terms of the number of times it happens. So there's a skewing for sure in over history that I feel like March, June, September, and December are bad months for growth. Now, if you just said, Tom, what's the worst time to be in the stock market? I'm going to tell you mid-July to September 26th. I mean, I got that Excel spreadsheet that gives me all that information, and that is non-debatable. I mean, I can show you numbers. That is the worst time of the year to be in the stock market historically. Doesn't mean next 20 years it's going to work that way, but since 1950, that's been the case. And, I think that there are some reasons for it. I think a lot of folks vacation that time of the year, so it's lighter volume in the market, easier to manipulate prices. So there's probably some reasons for it. But so it just, I guess, depends on how you word the question in terms of weakest. Or if you're looking at certain asset classes, or growth versus value, that sort of thing. You can get into other areas and look at some of the more defensive areas like XLU versus the S&P 500. And then all of a sudden, over the last 5 years, March has been the best month. And you go back the last 20 years, March has been the best month for utilities. So it just depends on what you're looking at, when you go through this. But hopefully that gives you some answers.
So last question. Dun, 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 dun. So we have setting up CandleGlance like you. So I think you showed it in the live trading room this
Uh-huh.
past Wednesday. Basically your CandleGlance, and they were
Yep.
wondering how to set it up just like you.
Okay, so first thing you have to do to use CandleGlance on a chart list is you have to set up one of these style buttons and call it CandleGlance. That's what, when you pull it up in your chart list, it's going to look for. So right now, I mean, if I just go over here, let's just take a look at Tesla. I always like to see what Tesla's doing anyway. It's not really doing much today. Um, if I pull up my CandleGlance, so I just got to go up here. Actually, I don't have it featured. I think it's down here. Yeah, it's not one of the buttons that's up top. It's down below. So here's CandleGlance. And it doesn't have to be one of your live style buttons. You just have to have one that's called CandleGlance. And the way you do that, I think the way I did it in the trading room was I was interested. I was looking at the strong AD chart list from what I recall. And so the only thing I wanted to do was to see the stock price and the AD line. That's all I wanted in my CandleGlance. So what I would do is I would go down here and I would get rid of everything else. So I don't care about these indicators. I'm going to clear those. I don't care about the moving averages. I'm going to clear those. Don't care about volume. I'll get rid of that. I've got my my candlesticks. I think that's, oh, and then just pick do you want it for a year? What's your time frame? And, I'll pull up 6 months. Could be a year. But anyway, so then I update this chart. And now when I look at this chart, the only thing I see, oh, I got to go back in and put my AD line in. Now I'm going to put the AD line in, height 1.0. And so now all I have is price action on Tesla and the AD line. Now, what you have to do from here is go in here and hit this plus button. And if you haven't already set up a CandleGlance, then you got to pull up a CandleGlance. Now, I'm going to click on it because I already got it set up. If you don't have it set up, it'll just say, do you want to, new or cancel, something like that. But because mine's already set up, it's saying, do I want to replace it or do I want to cancel? Well, I think I've got it set up right now for a year. The same chart, it's just a year instead of 6 months. So I'm going to hit replace. And so now this is my new CandleGlance chart that if I pulled it up over here, which again, I think it's not showing. Yeah, it's going to reorder all my stuff. But if I hit something, on the chart list that says CandleGlance, it'll go find that preset button and the chart style for me and add it. So let's go into the strong earnings chart or the strong AD chart list. And let's go to view all. And then let's go to CandleGlance, because this is the way I can look at every stock or everything on, wait a minute, that's not, I need to pull up strong AD and then CandleGlance. Okay. So now if I pull up the CandleGlance, every chart that I have in my strong AD chart list, which I don't know, there's probably 200 and some charts, every one of them will show up on a CandleGlance. And when you look at the CandleGlance, you can go down all the way. Every one of these are set up, but look at the chart style. So the chart style is only the price action and only the AD line. That's all it shows for me. Now, if I go back and I change my CandleGlance, let's go back to Tesla again. And so now what I want to do is, let's say, I don't care about the AD line. I want to know price performance. And I'm just going to, I haven't even tried this before, but price performance symbol. Yeah, let's do symbol versus industry. See if that works. And we'll just, we got our moving average. We've got everything else on here. I'll make this 1.0. Update. So down here below, I've got Tesla relative to the automobiles. So now I could go in here and hit this plus button. I could call this my CandleGlance. This is going to be my new CandleGlance. So I'm going to replace that. And now I'm going to go in and I'm going to look at my strong earnings chart list. And this would be a useful thing to do, just to, quick CandleGlance at how a stock price is doing and how it's doing relative to its peers. So now on the strong earnings chart list, I've probably got 450 companies on here. And if I set it up to CandleGlance, now I can go through every one. Here's Brown and Brown. It tells me that this is obviously in an insurance area, casualty and property insurance. And it's been trending up versus its peers. Cadence is in software. So it's been downtrending a little bit relative to its peers, although it's starting to strengthen a bit. But you could look at this and literally look for a stock maybe that's breaking out, that's starting to show some relative strength. Or maybe it's a stock that's been showing great relative strength, but it's pulled back to its 20-day moving average. I mean, I'm just going to kind of look through here and see if anything looks interesting. Welltower. I mean, among specialty REITs, this is one of the best specialty REITs out there. And if you look at the chart, it's been going up. It looks to me like maybe it's a cup starting to form. But you could have looked at this back when it was hitting price support down near 120 or 122 or whatever. And you might have looked at it then and said, wait a minute, I'm hitting price support. At the same time, I've got good relative strength. And you could have entered this thing, $8 ago, maybe. But that's, again, I could have looked at Allison Transmission. Look at it pulling back to gap support. When it was pulling back to gap support, if you had this pulled up with this relative strength, you could see that it's a very strong stock in its group. And it just hit a key gap support area right before this latest. So I'm trying to find one that maybe would make sense now. So I definitely want relative strength. And then looking for support at the same time. Anyway, this could take for a while, but anyway, hopefully this kind of gives you an idea. I mean, here's Modine, another one that kind of pulled back here, kind of almost on a trend line, close to the recent support. This was a very strong stock in the auto part area, and it had pulled back a little bit, but was still clearly uptrending. And this stock, since it did this, is up probably about 13%. So anyway, hopefully that helps on how you can use CandleGlance.
Absolutely. Great stuff, Tom. Thank you so much for helping out today.
Yeah, this was a long set for sure. I make it longer, no doubt, but try to explain it thoroughly. I do like everybody to get a better feel for what we do, and some of the things that you can do over at Stock Charts. It's a really powerful platform. That's why we use it. I trade using it. So it just makes sense, I think, for a lot of our members. And I think a lot of our members do have the stock charts platform. New members, we are not at all related to stock charts, by the way. No financial relationship whatsoever. I know the folks over at Stock Charts. I do a lot of, videos at Stock Charts. I write articles at Stock Charts, but we have no financial relationship one way or the other. So whether you subscribe to Stock Charts really doesn't matter to us at Earnings Beats. But if you do, I think you're going to get the benefit. I think you'll get more benefit out of our service by being a Stock Charts member. And usually, extra and pro level services will make more sense because you'll have access to more style buttons, you'll have more access to chart lists, you'll have more use of scans, regular scans that you can run from time to time, the number of scans that you can save. There's a lot of benefits to being an extra or a pro member as opposed to being a basic member, and certainly versus a free member over at Stock Chart. So anyway, just thought I'd pass that along as well. But it's been a pleasure. Matt, thank you for taking time out of your day, come in and ask the questions, and give us some feedback on this new system that we're doing. We're trying to do these Q&As every Thursday, as long as it doesn't get to a point where I'm in here talking about it for 4 hours. I think that might get a little tough. Might have to try and cut short my answers if that's the case. Or at some point, maybe have to limit the questions, maybe try and combine them or something. But anyway, we are trying to reach out. We're trying to give everyone a great customer service experience here at Earnings Beats. So again, thanks to Matt for coming on board. Thanks, Tyler, for taking your time recording all this, time stamping it, and the stuff that you do in the behind the scenes as well. But that's it. Everybody have a great rest of your weekend, and happy trading.